Welcome to the Lane Gorman Trubick COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with the information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. This webinar is about resources provided to businesses and individuals with the CARES Act. It was recorded live as a Zoom webinar on April 8th, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible. Please enjoy.
All right, it is 3 o'clock. Let's go ahead and get started. I know folks are still in the process of signing in, but I want to be respectful and start on time. All right, my name is Lucas Lachance, and I am a partner here at Lane Gorman Trubick, responsible for our business development as well as our community outreach. Looking down the list of attendees today, I see that there are a number of folks that are already friends of the firm. But for those of you that are new, I want to take a minute or two and tell you a little bit about what we do at LGT. Obviously, we do anything tax related, that's why we're here today. But we also offer assurance services, including compilations, reviews, and audits, as well as accounting and consulting services like CFO by the hour and monthly bookkeeping. We also have a financial advisory group that handles financial planning as well as asset management. If you haven't had a chance to check it out, please visit our COVID LGT resource page as part of our website. A link to that will be sent out in the chat. Additionally, all the presentation here today, as well as any of the resources, will also be available via a link that we'll send out through the chat too. And if you haven't done so already, take a second and visit us and follow on social media. We're on LinkedIn, Facebook, and Twitter. Those are great resources to find out more about events just like this one that we'll be having in the future. Let me tell you a little bit about how this webinar is going to work. I'm getting ready to introduce the panelists first, but also I want to let you know that behind the scenes, we have a team of professional tax folks that are there to answer any questions. So if you have anything that crops up during the presentation, send it on over through the chat, and our team will be working in the background to see if we can get you an answer while we're all here together. I'd like to go ahead and introduce our two panelists today. First up is Matt Dubay. Matt will be covering the individual and business tax provisions of the CARES Act. Matt joined our firm in 2014 and brings more than 10 years of professional experience. His tax experience includes corporate structuring with an objective of aligning the appropriate strategy with each taxpayer's needs. His annual tax compliance duties encompass comprehensive review of tax engagements, including step-by-step presentation of tax adjustments. He's also active in year-long tax planning analysis and complex research projects. His primary focus is and remains client service. He's joined today by Matt Peck. Matt Peck will cover the stimulus program later in the webinar. But for the past 2 decades, Matt Peck has been providing strategic taxation planning and consulting advice. As the leader of the firm's international tax practice, Matt has a depth of experience that is required for any organization with international operations. An expert in trade agreements, Matt is well versed in the rules and regulations that govern import-export activities and how to best maximize your company's strategies. Working across several industry sectors, Matt partners with a number of organizations that are both publicly traded and privately held. Ladies and gentlemen, I give you Matt Dubay and Matt Peck.
Thank you, Lucas. That was a very kind introduction. I'd like to kind of go through a couple of slides. Bear with me. Just a quick disclaimer that we want to throw out for everyone. While we're trying to be as formative as possible, we want to make sure this is just an information session, and additional support should be consulted and asked for versus just using this as the end-all information. So again, a quick agenda for today. We're going to go through some business tax law changes, individual tax law changes, go through some stimulus payment updates, as well as some available business credits. And then if time permitting, we'll have some Q&A. Again, if you have any questions throughout the presentation, we do have a group of panelists answering those questions as well, so we can keep everything moving. So let's start with the business tax law changes that came with the CARES Act. To do so, one thing I'd like to do is kind of look between the old law and the new law. And when I refer to the old law, we're talking primarily about the Tax Cuts and Jobs Act. So just for ease of presentation purposes, I won't be referring to the Tax Cuts and Jobs Act or TCJA verbally throughout. Just keep in mind, if we state the old law, more than likely it's Tax Cuts and Jobs Act. Otherwise, we'll make sure that you know it's something else. But with the old law that was passed in 2017, NOLs created in 2018 or later could only be carried forward and would be limited to 80% of taxable income. This was a huge change from the past when you were allowed to carry back NOLs and you were able to use the full amount against taxable income in a subsequent year. Well, with the new law in the CARE Act, NOLs created in 2018 through 2020 can be applied as follows. So the NOL can be carried back 5 years. That means that if an NOL was created in 2018, that NOL can be carried back to your 2013 filing. So even though the statute of limitations has lapsed on that, which is 3 years, the general rule, the NOL can be carried back that far. That's a big advantage because you'd be carrying back NOLs into periods where tax rates were higher. The new law, the old law enacted a corporate tax rate at 21%, where the highest tax rate was a gradual system that went all the way up to 35%. So an NOL that was created in 2018 or 2019, and then again through 2020, can be carried back into a period that you paid more taxes. Any remaining NOL after you carry back the NOL can be carried forward and applied against 100% of a taxpayer's taxable income. This is, again, a big advantage instead of applying that 80% test. So keep in mind that losses arising in 2021 and forward will revert back to the old treatment in the old law, the 80% of taxable income limitation carry forward and no more opportunities to carry back the NOLs. So this is something that you definitely want to be cognizant of and go ahead and look through other filings to get that tax back. Another area that the old law changed was that the AMT tax for corporate taxpayers only was permanently eliminated. However, taxpayers could still potentially have an AMT tax credit. AMT tax credits were created once you paid AMT tax in lieu of paying regular income taxes. And in a subsequent year, once your regular tax was greater than your AMT tax, you got a refund. Well, in the old law, you were able to get a refund on those AMT tax credits, and you were only allowed to apply 50% of your current federal taxable income against the available AMT tax credit. And then in 20 later years, the full amount would be refundable. Well, under the new law, any remaining corporate AMT credit is now 100% refundable on the 2019 return. So this is another big advantage of these credits that will give more cash flow to businesses. Another large change was the relaxation of the business interest deduction limitation. This was truly a new addition to the tax code when the old law, the TCJA, was in effect in 2017. And the IRS added a limitation that you would only be able to deduct 30% of your interest expense based on your adjusted taxable income. And adjusted taxable income was defined as your taxable income without tax depreciation, tax amortization, or interest. And so this computation and taxes, excuse me. So in essence, you were looking from an EBITDA perspective. Well, under the CARES Act, generally allows businesses, unless they elect otherwise, to increase this limitation to 50% of ATI for 2019 and 2020. So what does that mean? That in 2019 and 2020, you may have filed a return that used the 30% limitation, and now you'd be able to take the 50% limitation. So that's one thing to watch for. The other side is that partnerships are still subject to the 30% limitation for 2019, but they're eligible for 50% in 2020. To make matters even more confusing but advantageous to partnerships, in 2020, if a partnership had a limitation on their business interest expense that was carried forward into 2020, one half of that carry forward may be used on the 2020 tax return as a valid business deduction, of course, subject to limitations such as passive activities or at-risk rules, regardless of the current year's ATI. Also, under this rule, taxpayers may also elect to use their 2019 ATI in computing the 2020 limitation. This can be big with everything that's going on in 2020, that your interest expense can potentially go higher against all other income items. So if you had a strong 2019, I'd strongly consider electing to use the 2019 ATI in 2020. And all of this will be ever evolving as we get more guidance. Also, this business interest deduction still does not apply to any taxpayer that has average gross receipts of 26 million over the trailing 3 years. So and there's other limitations that apply with business interest, but if you're under 26 million, you're still able to deduct your interest. Those rules haven't changed as well. Another large area that came out was the technical correction to restore faster write-offs for interior building improvements. The old law did a great job of combining leasehold improvements, restaurant improvements, and retail improvements into one classification, and they called it qualified improvement property. And for simplicity, we'll call it QIP. However, the 2017 tax law failed to distinguish this property as 15 years bonus eligible property. Instead, the property reverted back to its former classification as 39-year non-bonus eligible property. So if you made an interior change to a piece of property that you're leasing in 2018 or 2019, you were depreciating this over 39 years. However, all that's changed. The new law, the CARES Act, retroactively fixes this issue. In the profession since the law was passed, the old law, we've been asking and requesting for technical corrections, and it finally came under this act. Now, this act is retroactive to 2018. So, for example, if you had leasehold improvements on properties that you were leasing, and it was an interior change, an interior non-structural change to the property, and you're depreciating it, you probably saw in your depreciation report that it was depreciated 39 years. Well, it now can be depreciated under a 15-year life and is eligible for bonus depreciation. Bonus depreciation in 2018 and 2019 is at 100%. So you would be awarded 100% write-off of this improvement. And a lot of times these leasehold improvements can be very sizable. So the deduction that can be available and should be looked at can be very sizable. One area that we don't know yet and we're waiting on guidance for is, because it's retroactive, will taxpayers be able to file a change of accounting method under 3115? Or does a taxpayer need to go back and amend the tax return for this change? Hopefully it'll be a 3115 change, because it sounds like, because it was retroactively fixed, it's changing from a formerly permissible method into a current permissible method. But only time will tell on that, as we're still waiting for some further guidance on this issue. Another area that came out was the delayed payment of employer payroll taxes. Under the old law, it was pay your taxes timely. So this is something new and very specific to the CARES Act. Under this, you'll be able to defer paying the employer portion of certain payroll taxes through the end of 2020. And the payroll taxes that are included in this are the Social Security tax, the 6.2% on only the employer portion. So the employee portion still needs to be remitted. If you choose to go down this route, you are just deferring payment that needs to be made in 2021, one half of it, and the other half will need to be made by the end of 2022. Keep in mind, if you take advantage of this delayed payment, you cannot use this in the same way, and you cannot use this with the PPP loan. So this is available, but the IRS has made sure that you're not double dipping on these different type of opportunities. Another area to look out for is the exclusion for employer payments of student loans. While the dollar amount hasn't changed, the use of the employer payments has changed. Now, historically, only benefits for an employer-sponsored educational assistance program was allowed to exclude $5,250 from income. However, that $5,250 now can be used and excluded from an employee's income if it is used to pay for the employee's qualified student loan debt. So this is one area that employers should look to see if they need to change any of their policies in place so that employees can take advantage of this, or you want to maybe be specific and that we're sticking to that we can only use it for educational assistance. Just keep in mind that that is available. Charitable contributions. So we're going to take a look at this from a corporation perspective. Under the old law, cash contributions were limited to 10% of modified taxable income, and contributions of food inventory were limited to 15% of modified taxable income. Well, under the new law, they've increased those percentages. So if you give cash contributions, and keep in mind this is cash, this is not a non-cash type of contribution, that needs to be, that can go up to 25% of the modified taxable income of a C Corp. Contributions of food inventory have increased as well to 25% of modified taxable income. So I want to make sure that it's something to be cognizant of so that we can still be charitable in this time. Switching gears, we're going to jump into some individual tax law changes. And I think it's a good segue because charitable contributions also change for individuals. Individuals under the old law could give, and again, we're speaking of cash contributions to public charities. There's a lot of other rules that come into play depending on if you're giving to a private foundation, to a just a general foundation, or different types of non-cash, cash. What we're talking about are cash contributions to public charities were limited to 50% of a taxpayer's modified adjusted gross income. Under the new law, cash contributions to public charities in 2020 are now 100% deductible up to a taxpayer's modified adjusted gross income. Again, this is only for 2020. So, and any carry forwards will be subjected back to the 60% limitation. So when you're making your charitable contributions, while it's very good to be charitable, the other side is that you're only able to deduct up to the amount of modified adjusted gross income that you have. Just, you won't lose it, just know that that's the max you could take it for 2020. Also, for 2020, there is a new above the line deduction. So if you don't itemize, you are allowed to take, and you want to still be charitable, there's a $300 deduction that's available to taxpayers for cash contributions as well to public charities. Just keep in mind, this cannot be used if you do itemize. This is only for taxpayers that do not. Another area that became retroactive was a non-corporate taxpayer loss limitation. Under the old law, if you were active in a business and had deductible losses from pass-through entities, you were only able to use up to $500,000 of those losses to offset other sources of income. So you could be in a position where your pass-through entity had large losses, primarily it could be due to depreciation that had a lot of acceleration, but you weren't able to use those in 2018 or 2019 because there was a limitation on it. However, the new law, the CARES Act, added a technical amendment that was also retroactive to suspend this limitation on non-corporate losses for 2018, 2019, and 2020. Again, after 2020, the limitation will apply again. However, you may go back and look into the 2018 tax return to see if you need to amend that return as well, because those losses that were previously suspended are now available. This will also alter your carryovers into the 2019 tax return. So you want to make sure you look at the 2018 return before finalizing the 2019 return. Otherwise, there could be an issue where you're amending two tax returns and it's just adding a lot of unneeded work. Another area that became big was the waiver of required minimum distributions. So under the old rules, if you were 70 and a half in 2019, the Secure Act changed that to 72 in 2020. But if you were 70 and a half in 2019, you were required to start making minimum distributions. However, the TCJA came back and changed that and said, we're going to waive this for 2020. So if you turned 70 and a half in 2019 and elected to defer your first payment until April 1st, 2020, or into the first quarter of 2020, you are not required to take that distribution. Now, you do have the opportunity to refund the distribution under the 60-day rule that is in effect. So if you were to have taken it last week, you could go ahead and refund that within 60 days, and that would not count towards your required minimum distribution. One item that the IRS is floating around is correcting the 60 days and making it a longer period, as some taxpayers took their distributions in January, at the beginning of the year, and once the tax law was passed, they were not able to recontribute the funds back because their 60 days have lapsed. So we're keeping an eye on that, and we will see if that will change. The other side to think about, if you are required to take a required minimum distribution and you're, say, 72 already this year or 73, and you've already done so, it may be helpful to put the money back in if you don't need it and retake it back out at a later date towards the end of the year. Because as of right now, that 60 days is the law. So if you are outside of that 60 days, it is taxable income. So just something to think about. Another area that the IRS removed was the waiver of the 10% early distribution penalty. So this additional 10% tax on early distributions from IRAs and defined contribution plans is waived during the January 1 through December 31st, 2020, if it is used for coronavirus related purposes, or if it was needed because of a coronavirus effect. To be affected by the coronavirus in this definition is if you yourself are infected, if you or a family member are infected, or if the lack of having childcare and the lack of having specific benefits has hindered your opportunity to make income, then you would be eligible to take this distribution up to $100,000 from your IRA. One note that is key on this, that the distribution that you take from your IRA is taxable over the next 3 years. So while you are waived of the 10% tax on early distributions, you would still pay tax on the general distribution as well. So it's something to be wary about and love when you other side, again, that you'll have a 3-year period to pay the taxes back. There's also some stipulation that you'd be able to recontribute back into your IRA within a 3-year period, and the money would not be taxable as well. If that is the case, and that's something you want to look for, I would suggest talking to your financial advisor to see what your plan is able to help you with. Another area is the break for non-prescription medical products. So HSAs and Archer medical savings accounts can only be used to purchase prescription drugs. However, under the new law, you are able to buy those items with the non-prescription items with HSA funds as well. Hopefully that was informative to everyone. Those are the key provisions that have come out. Again, we are still waiting on guidance. Right now, we have a list of changes. Regulations have not been written and other comments have not been put out yet, other than some frequently asked questions. And so as more of this information becomes available in greater detail, please keep an eye out for publications that we'll send out to everyone. With that, I'm going to pass it on to my esteemed colleague, Matt Peck, that is going to jump into some credits that are available, as well as the stimulus check that I'm sure everyone has heard of. Thanks.
Thank you, Matt. Yeah, I'll go over some business credits, and then the individual stimulus checks that should be coming out soon. So the first business credit available is the employee retention credit. And it's worth noting that if you take advantage of the payroll tax deferral that Matt covered earlier, you would not be eligible for this credit. The CARES Act created a new credit to encourage employers to keep their people on the payroll. And the credit is equal to 50% of the qualified wages paid during the period of March 12th through the end of the year. And the credit is able to offset the employer share of Social Security taxes only, but it is a refundable credit. So if the credit calculated is more than the Social Security tax paid, you could get a refund of the excess. The eligible payroll must be reduced by some of the new qualified leave acts that we're going to cover at the end of this. Total wages that can be considered for this credit is up to $10,000 for employee. So if you think about a 50% credit on $10,000 of max wages and benefits, you've got a $5,000 credit for each employee potentially. Now, if you take advantage of this credit, you cannot apply for or obtain a paycheck protection loan. Next slide, please, Matt. Okay, who gets the credit? Any employer who is carrying on business in 2020 and satisfies one of the following requirements. There's a furlough test. So if your operations have been fully or partially suspended due to a government order limiting commerce, travel, or group meetings, you may be eligible. Or if you have a drop in gross receipts in any 2020 calendar quarter, and it would be looked at, you would compare the 2020 calendar quarter to the prior year, same quarter. And if your gross revenue is down 50%, you're eligible for the credit, and you continue to be eligible for the credit until your quarterly gross income increases to at least 80% of the prior year's quarter. So you could be eligible for multiple quarters in getting this credit, and this includes tax-exempt organizations. Slide. Okay, so what are qualified wages? It depends. If you had less than 100 full-time employees, all wages count during the period of March 12th through December 31, 2020. If you had more than 100 employees, only the wages paid to people who are unable to work count for the period. And then in counting the 100 employees, related employers must be aggregated. And then, yeah, thanks. Okay, you cannot count wages paid to family members of a 50% or more owner of a corporation or partnership. So you can't have kids and spouses and cousins on the payroll for the purposes of obtaining this credit. And then no deduction is allowed for wages equal to the amount of the credit claimed. So there's no double dip. Slide, please. Okay, the individual recovery and rebate credit, also they're calling the individual stimulus checks. Those should be coming out within the next couple of weeks. So what you potentially can get, depending on income levels, is if you're single, you could get $1,200. If you're married and filing jointly, you could get $2,400, plus you get $500 for every dependent child under the age of 17. And we have not seen a limit on the maximum credit available, but the credit does phase out depending on your income levels. And it's 5% of your total income in excess of certain levels. So on a joint return with no children, you would see your credit phase out between $150,000 and $198,000 of gross income. If you're a head of household claiming one child, you would see your credit phase out between $112,500 of gross income and 136,500. And then for the single taxpayers with no children, that pays out 75,000 to 99,000. Okay, who is eligible? Basically, any U.S. resident and I got it backwards, but any U.S. resident who's not claimed as a dependent on someone else's tax return is eligible, and estates and trusts are not eligible. Slide, please. Okay, so the basic structure is this is going to be an advanced payment of a 2020 tax credit. So the advance payment is less than the actual credit, the taxpayer is entitled to the credit calculated on their 2020 return less the advance payment, so that the taxpayer will get the extra benefit. If the payment is more than the actual credit, so if the advance payment is more than what ultimately ends up showing available on the 2020 tax return, you don't have to pay it back. Now, slide please, Matt. These are going to be paid out based on your 2019 tax return if you filed it. And if you have not, it'll be paid out based on the parameters within your 2018 tax return. If you haven't filed either tax return because you weren't required to, they're going to look at Social Security benefit statements to see if you would otherwise qualify for the credit, and they will pay it in advance. And again, if you were not to get a credit for various reasons paid in advance, you are eligible to still get the credit on your 2020 tax return if you're eligible. Taxpayers with little or no tax liability, but at least $2,500 of income will be eligible for a minimum check of $600 if you're single, or $1,200 if you're married. Slide, please. Okay, when and how will I get paid? The IRS will be making payments as soon as possible. They were saying when this law first passed, it'd probably be 2 to 3 weeks. So we're about 1 week in, maybe a little more. So hopefully we'll start seeing them within the next week. And they will be made until December 31st of 2020. So if you haven't filed your 2019 tax return, and that would prove up that you're eligible, if you otherwise are not based on a 2018 return, they're gonna keep issuing these stimulus checks through the end of the year. It'll be paid electronically if the IRS has that information on file. And that would be information you provided them about a direct deposit of a refund check between January 1 of 2018 and now. There's not going to be any interest paid on the advance payments, and the IRS will mail you a notice saying how they sent the money to you and where they sent it within 15 days of either the direct deposit or the issuance of the check. And these checks will not be grabbed to offset other tax liabilities you might have. Okay. In the Families First Act, there was an important new employee benefit, a couple of employee benefits that were required for employers to provide if they had fewer than 500 employees. And the first one was the Paid Sick Leave Act, which is going to provide 2 weeks paid leave for a couple of different categories of people. First is if you're under a federal, state, or local quarantine, you were advised by a healthcare provider to self-quarantine because of underlying health conditions, or if you have symptoms and are seeking diagnosis of COVID-19. So those 3 categories are eligible for 2 weeks paid leave up to 80 hours based on the greater of their regular pay or minimum wage, but not more than $511 a day. And that's going to be paid for via a reduction in your payroll tax deposits. So in theory, you would be reimbursed for the payment of that leave via reduction in your payroll tax deposits. And if your payroll tax deposits are not sufficient enough to cover the expense, you can seek a rapid refund. This same paid leave act covers 3 other categories of people. If you have to care for someone who's under a quarantine order, you have to care for a child whose school is closed or their child care facility is closed, or if you have a substantially similar condition specified by the HHS, you're eligible for 2 weeks paid leave at 2/3 of your normal pay, but not more than $200 a day. And this, again, is paid for by those same payroll tax deposit reductions to be offset by credits when you file your payroll tax return. Okay, who is covered? Employees who cannot work or telework due to caring for a child whose school or child care facility is closed. Did we jump a slide, Matt? You know, maybe not. Okay. Go ahead. And then what is the effective date? Yeah, okay, who is covered? Employees who cannot work or, yeah, I got that. What is the benefit? 2/3 of pay not greater than $200. Oh, the slides got mixed up, I think. Go one more. I think we maybe lost a slide or two, I don't know. New refundable payroll credits. All right, go back one. I think I know where I am now. Okay, then there's an expanded Family Medical Leave Act. So this is going to cover a 12-week period. The 2 weeks would be non-paid, and then the following 10 weeks would be paid. And this kind of piggybacks on the first Leave Act, where if you had a child that was out of school and unable to attend daycare, they could qualify for the 80 hours. So this is for that same person, an extension of benefits for 10 weeks paid at that same rate, 2/3 pay, but not greater than $200 or $10,000. So next slide, please, Matt. The effective dates for both leave plans are April 1 through the end of the year. So any employee who becomes eligible, and a lot of them are already, could get this benefit. How it works: employers with less than 500 employees at the time the leave is taken must provide paid sick leave and paid expanded family and medical leave under these acts. And the employers are entitled to claim refundable payroll tax credit to offset the cost of providing the leave. Slide. There are exemptions available for employers with less than 50 employees if complying with these leave acts would jeopardize your business, and those could be things like it's a key person that can't be easily replaced, or if complying with the plan itself is burdensome on the organization. Who is counted in determining the 500 employees and below? It's full and part-time employees in the US, those employed through temporary agencies, jointly employed, and employees on FMLA or sick leave. Who's excluded? Basically, for most of us, independent contractors, and then certain federal employees are excluded. And how is it all paid for? Via refundable payroll tax credits to the employers. So on the Paid Sick Leave Act, the first act, it's $200 a day or $511 a day for up to 80 hours, depending on which category you were in. For the Expanded Family and Medical Leave Act, it's limited to $200 a day or $10,000 for the full 10 weeks. And qualified health insurance costs are allowed to be included in these calculations, and it is available for self-employed individuals. How do you claim the payroll tax credit? So you're going to reduce your payroll tax deposits immediately. And if you're not able to recoup the expense of this benefit via that, there's a refundable credit that's going to be claimed on a form 7200. It's a brand new form for advance payments on the employer credits due to COVID. Slide. And I guess that brings us to the end of what we've prepared. We could probably go over a few question and answers.
I have one comment I wanted to bring up that I remembered. We're talking about required minimum distributions and distributions. In the waiver of distributions, one of the items that was passed with the Secure Act was that if you inherited a retirement IRA type of fund, you had 5 years to liquidate that fund. That process of making that distribution mandatory for 2020 has also been postponed. So that 5-year period would not start this year. If someone passed away this year, you would have the 5-year period would start next year. So keep that, just something to think about as well. We also have some questions. Go ahead, Matt.
One thing I came across recently that I was unaware of, that there's been an enhanced charitable deduction for C corporations who provide, or who basically donate inventory items to charities for the needy, ill, or infants, and you would get a charitable donation. Your cost of the items would obviously be deductible, but then they were able to be increased by either 1/2 of your normal markup or up to 2 times basis. So those rules are available for all taxpayers for food inventory, and subject to those limits that Matt went over. Normally 15% of income from the business, but now it's up to 25% of income from the business. So if you're donating, if you have inventory that's food items, you donate it to a soup kitchen, or possibly even providing prepared meals to a hospital for the doctors and nurses working, you may be eligible for that enhanced deduction.
One item that came up as a point, your stimulus check can be seized for back child support. So if you have back child support, that is something that the IRS can seize. So you may not be getting a stimulus check if that's the case. Looking through.
Emergency. Okay, so here's a question. Can the emergency paid leave payments and emergency family leave be used if we've applied for or received a PPP loan? And the answer is, well, I think no, but if you've applied for the loan, you shouldn't be claiming that. Well, hold on, I got that wrong. You're not able to use the PPP loan. I'm struggling with that.
Hey, Matt.
Yeah.
This is Denver. Can you hear me?
Yeah.
I think when you're requesting forgiveness on the PPP loan, you cannot count any wages that you paid for emergency sick leave or the emergency FMLA. They wouldn't count as wages towards the expenses that you're adding up to try and receive forgiveness.
Yeah, that's it. Thank you.
See if there's any other questions. I did see a question about the PPP filing. We had a webinar back on last Friday going over specifically the payroll protection plan loans. We do have those slides available and that information available. So if you'd like that information, please let us know and we can get that information out to you as well.
I have one question. So if I had a high income in 2019, but I lost my job, do I still qualify?
For the individual stimulus check, if you file 2019 and you're ineligible, you won't get the advance payment. But when you file your 2020 return, if you are eligible, so if you fall below those total income guidelines, you would get it at that time with the filing of your 2020 tax return. So here, Matt, I've got a couple that are in your section. So regarding the NOL changes, if forgiveness of a PPP loan is not taxable, must a business reduce its current year expenses or NOL carryback or carry over by that amount?
That's one area that we're still looking into. I know it's very vague as far as the interaction between the two areas, and we're hoping for further guidance on that area.
Okay.
Also, we're waiting with the extension of the filing deadline moving to July 15th. The quarterly payments are still showing due as of 6/15 for your second quarter payment, even though your first quarter payment isn't due until July 15th. So we're waiting on a technical correction on that one. I think it was something that was done in haste to push everything out. These filing deadline changes happen very quickly. In fact, I believe the first mention of the filing date change came through Twitter. And so it wasn't very authoritative right away, but since they've made that clear through an IRS notice, there's just some particulars that I don't think they were worrying about, because that was around the same time that the CARES Act was being drafted and they had some bigger issues at hand.
Well, looks like there's a few kind of specific questions in the Q&A that we can get to offline.
I agree.
You have anything else, Matt?
A lot with the tax law, again, just to reiterate, a lot of the tax law, it seems very, very straightforward in just what they've changed, but there are a lot of other exceptions that will apply. So we are waiting for the FAQs to come out on these different topics, as well as regulations, because this can expand to a lot of different areas. The main one we're waiting on is to determine what we need to do with the new qualified improvement property, because that could be a drastic change between filing an amended return and filing a change of accounting method. So there's some big implications there. Or if they give us the option that you can amend, or you can file a change of accounting method. Specifically, if you had changes in partners and those partners are no longer, the percentages have gone down or something's changed in the following year with partners, they would probably want that deduction on their individual return as well. So a lot of this is hurry up, we'll put this out and we'll wait. The 2017 tax law that went into play took them about a month to draft, and it was ridden with holes and a bunch of issues that needed technical corrections. This law that came out, while it is pretty straightforward, there's probably something out there that we haven't thought of, that someone has thought of, that they'll need to clarify in another arena. So hopefully we'll be able to get better guidance in a much faster fashion, because the technical guidance on the 2017 tax law was extremely delayed. So just a caveat to make sure that that's what we're looking at from our angle. Anything else that you have to say, Matt?
Thank you for joining us. As more guidance comes down from our government and the IRS, we will pass that information along to you on our COVID-19 Financial Updates resource page. The link is in the description below, along with other important links, including our social media. If you want to see more of the past COVID-19 financial webinar series, subscribe and select the bell icon for notifications. Thanks so much.